Hello, I'm Andrew Lockhart from Metrics Credit Partners. For those of you that are not familiar with Metrics Credit Partners, our business is involved in directly originating and providing debt finance to a range of Australian and New Zealand based companies. We launched our first fund back in June of 2013, and today we've been very fortunate to be able to grow our business to now close on 16 billion of assets under management, providing a valuable source of financing for Australian and New Zealand based companies. Our business, we employ around about 130 people based in Sydney, Melbourne and in Auckland in New Zealand, are the key areas of activity for our business. And our lending activity really covers the entire spectrum of lending to large Australian or New Zealand based companies. We term them as acquisition finance or leverage finance, corporate lending, project and infrastructure finance, and also commercial real estate related lending. What is private debt? Most Australian and New Zealand based companies don't have a credit rating, and so their ability to tap alternative sources of debt financing away from the banks is quite limited. Australia doesn't have a deep corporate bond market of any size or scale, and so again most of these companies are reliant on banks for funding. So private debt is really a loan agreement that is struck between a lender and the borrower that is confidential to the parties that are involved, and it sets out the terms and conditions upon which we provide financing. So unlike a bond or an equity where it might be traded on an exchange, loans tend to be made for the period of say 3 or 5 years, being what we call a hold to maturity loan. So we're not active traders in debt. We provide financing to support companies and their activities to support their financing and their growth objectives. It is a bank-dominated market in Australia. In Australia, most of the debt financing is provided by the banks. And what we've seen in offshore markets, particularly Europe and the US, is increasing levels of activity from a range of private debt asset management firms that compete with and work alongside the banks to finance Australian and New Zealand-based companies. And that's our role and our activity. I think it's a particularly attractive asset class for investors, and one of the reasons for that is it delivers stability of capital, or can deliver stability of capital. The stability of capital is delivered in the form of where you sit in the capital structure, so lower risk than outright equity ownership. Often people are investing in shares or equities to generate growth in capital value. So you're investing in a company because the company is going to grow earnings, and as a result of that you expect the share price and the value of the company to increase. You invest in debt to generate an attractive income, but with reduced levels of volatility. And the reason that the stability of capital is a real feature of our asset class is, one, Australia has a very attractive corporate and legal insolvency framework that companies operate within. And so again, it's protection of a lender. So we all know that a lender that has security over the company or over a property ranks in priority to all other claims against those assets. And so the protections that are afforded to investors in debt as a result of the protection under Australian insolvency laws is beneficial to protect investor capital. It's a market where relationships are very important. To be able to seek out and find opportunities with companies, gain access to private information to be able to assess and monitor the risk. Again, it's a private market, so the information that we receive from the companies is used by ourselves to assess the company's capacity to generate cash flow, to service and repay their debt. But fundamentally, loans are a financial contract. They're an obligation imposed on the company that requires the company to service and repay its debt in priority to other payment obligations. And I think one of the things that's very interesting and what this chart shows is that the loss rates that have been experienced in the Australian corporate debt market have been very, very low. In fact, they peaked more than a decade ago, soon after the GFC or the global financial crisis, but they peaked at 0.67 of 1%. So very low loss rates in terms of the actual write-offs that the banks have been exposed to in corporate debt. And again, that really reflects where you sit in the capital structure. So again, if you think about a company's capital structure, the company's activities is financed through debt and equity. And obviously equity is the asset class that is the asset class at most risk in terms of a potential decline in earnings. And so if we think about as you move through an economic or a business cycle, obviously earnings might deteriorate the company's valuations might decline, but that risk of loss is borne by shareholders. And provided that the equity value and the earnings capacity of the company can continue to service its debt, then obviously a lender is entitled to receive its proceeds of the loan in full. And so again, we often say, we lend $1 today, we expect to receive interest and fees in relation to that financing that we've provided, and then on maturity, we expect to be fully repaid our $1. And so again, the risk of potential loss is not borne by debt, it's borne by equity first. Private debt obviously provides an alternative source of income for investors. And so again, it's an attractive source of income. The sources of income that we generate from our lending activity come from the fees that are charged to companies, the underlying base rate, so loans are priced over a floating base rate, so as the Reserve Bank has increased interest rates, so too has the total return for our investors. And then in addition to the base rate, which is a market base rate, a lender will charge a margin, and that margin will reflect the risk associated with providing financing. It will reflect the term of the loan that's being provided. It will reflect the ability of the company to source alternative competitive sources of debt financing. So there are a range of things that come into play, but interestingly, in an environment where investors have been exposed to duration risk and have been exposed to losses in traditional fixed income like bonds, private debt has provided an increasing income for investors in line with increasing interest rates as the underlying rates are floating. It provides diversification as well, beyond just simply the opportunity to invest in bank hybrids or in bank bonds. Again, Australia's fixed income market is very limited in terms of the true, genuine corporate issuance that investors can gain exposure to, because most borrowers will borrow from a bank. And so as a result of that, our activities provide investors with greater levels of diversification across the economy. There are key risks that an investor is exposed to, and primarily the greatest risk that an investor is exposed to is that risk of loss in the event of a default. And so again, working with a skilled lender that understands all of the sources of cash flow that can service and repay debt, that takes appropriate proactive action to structure loans to mitigate risk through appropriate controls, covenants, taking of security, all designed to mitigate risk, and then you monitor those loans and the borrower's performance on an ongoing basis to mitigate any potential risk of loss. I believe that when selecting a private debt manager, scale is very important. Obviously, if you think about other asset classes, you're often looking to diversify away from the star stock picker in an equities portfolio. In private debt, I believe that benefits of scale are delivered to investors because the manager can then use that capital to provide investors with access to well-diversified portfolios of corporate debt. But also the size and scale of the manager actually also delivers benefits in terms of the negotiating power. You become relevant to banks, you become relevant to borrowers as you work together to provide financing. But obviously an experienced team, our team at Metrics, over 130 people in the business now, long careers, working in banks and in financial markets, and have a real skill set in terms of origination and risk management. Our track record is very strong. You look at all of the various funds that Metrics operate, and all of our funds have exceeded their minimum target returns. We operate around 20 different fund strategies for different investors, and every single one of those funds has delivered a positive performance for investors month in, month out since inception, and delivered in excess of the minimum target return. And so the ways in which we've brought our skill set and the opportunity to invest in private debt for Australian investors is through the two listed funds that we operate. So the Metrics Master Income Trust was the first fund that we established back in October of 2017. It was the first ASX listed fund providing investors with access to domestic private credit or private debt investments. That fund delivers income to investors on a monthly basis, so distributions are paid to investors monthly. Since launch of the fund, we've seen the fund grow from initially $500 million to now in excess of $1.75 billion. Provides diversification currently to investors across in excess of 300 individual loans, where the average exposure to any one individual counterparty or borrower is less than 0.5%. The fund seeks to deliver a minimum target return of the RBA cash rate plus 3.25% net to investors, and since inception we've exceeded that target return. And currently, now as a result of the most recent RBA cash rate increase, yielding on a running yield basis in excess of 9.5% for investors. Investors can trade that on the stock exchange using the ticker code of MXT. The second fund that we launched in April of 2019 was the Metrics Income Opportunities Trust, MOT. That fund was designed to be an equity market replacement. Again, I see the role of private debt in investor portfolios as fulfilling two roles. At one end of the risk spectrum, MXT can deliver an alternative to traditional fixed income. At the other end of the risk spectrum, MOT can deliver an alternative to an equities portfolio. And so again, what we're seeking to deliver with the Metrics Income Opportunities Trust is access to private credit investments in Australia and New Zealand companies, delivering diversification across currently around 160 individual borrowers, where the return is generated from the interest and fees that can be charged to companies, but also where we have an opportunity to provide investors with exposure to equity-like investments. We might have negotiated a profit share, we might have taken warrants or options, or we might have acquired an equity interest in a company or a project that we're involved in financing, designed to deliver investors not only with an attractive income through the debt investments that we hold, but also to provide the potential to profit from investments in equity-linked investments that are also made through that fund. If you'd like to know more information about the activities of Metrics, please go to our website or follow us on LinkedIn for more information, or get in contact with our team. Thank you very much.